Let's bring in now Evercore ISI Senior Managing Director, Equity Derivatives, Quantitative Strategy, Julian Emanuel. One more thing. I mean, every time you come on, you got a new title. Congratulations.
Yeah, but my suit can never be as smooth as Pee-wee's after a fall.
None of ours. I mean, that was pretty good. And he meant to do that. It was so funny. I thought about that clip because you're looking for near-term, maybe stumble, a fall, or volatility, or anxiety, whatever it is, but we'll be okay after that.
We will. The first thing we have to do is debunk this concept of an earnings bubble, okay? That is not what we have. You already debunked the fact that we don't have a valuation or a stock bubble. Earnings, in our view, what the market's concerned about now, aside from the fact that it's going to be September and stocks don't do well when we all go back to school,
right.
Aside from the fact that the VIX is 15 and that's too low a level, given the fact that you have macro risk in front of you, is this idea that we hit peak earnings growth and peak earnings surprise this quarter. Guess what? We probably did. But the fact that we did that doesn't mean at all that we're entering a bear market.
Right.
It just means there's a little bit more volatility. Earnings growth is still going to be excellent instead of off the charts amazing, and that's going to be enough for stocks to move forward longer term.
So it's like Michael Jordan hitting 50 and then maybe settling the next day for 40.
Exactly.
Right. We're okay with that.
Exactly.
We're okay with that.
Exactly.
It's interesting because in your note you say, the call of the wild, right? It mentioned which is the classic. And you talk about the volatility, and of course the VIX. There's no volatility there, but you're saying there is volatility, and you talk about, in fact, it's wild. It's been pretty wild. The trading range is what you're talking about here.
Unbelievable. Like if you look at the charts of the mega cap stocks,
you put the Cosby and the Phillies in the Sox right here.
Yeah, well, and then you see they look more like Jackson Pollock paintings, and you can't figure out what's going on. But the fact is, again, these names, these indices have solid earnings and not taxing valuations, and they're going to grow their earnings next year. They're going to go higher longer term.
All right, so between now and then, though, because the midterms are coming up, you already talked about going back to school, the sort of things that happen, turbulence. We think back to 2018, you've talked about it, going down maybe into the election and then rebounding. You think we may have to deal with something like that?
It's likely to be volatile. It's hard to say exactly how it's going to happen. A lot depends on what we hear from Warsh at Jackson Hole, what the reports look like. And in fact, if you go back, part of the angst today is that we had, weak retail sales combined with that negative payrolls number last week. Either one in isolation would have been okay, but both of them together get people on the back foot. Does it actually,
though, ironically, does it give worse room, though? I mean, because the hawks on the Fed are saying, hey, jobs, we're not, they were solely focused on on the inflation part of the mandate, not necessarily labor.
So it does give him room, which is why if you look at the probabilities, the street is basically saying there's only a 30% chance that they're going to hike in September. But in our view, he's probably going to have to talk tough like he has these last few times since he started to convince people that he is serious about beating inflation long term.
You wrote that AI doesn't cancel the cycle, right? And this is just one table of. It's interesting. It says secular bull and bear markets. Really, it's been secular bull markets and periodically outside of 29. Periodic bull pullbacks. But what do you mean that? So don't get too comfortable with the notion that this time is ultimately different?
Right. So bear markets are a part of every long-term bull market, as these charts show. And, we had COVID in 2020. We had the financial crisis. We had the crash in 1987. But the long-term trend, driven by earnings, driven by technological development, continues to be up for us for stocks.
In the meantime, though, the firm has still an outperform communication services, consumer discretionary, information technology. This is what you say, listen, especially if you're not an options user, this is something you want to focus on. But I want to pull up the next screen because this is pretty intriguing, this notion of a new source of diversification. Kind of explain what's happening here and then how you're saying maybe we could hedge against this.
So basically what's happened this year in particular is that one of the reasons is because AI is such a dominant part of the index weight, And AI affects everything. It affects bond yields. It affects emerging markets. It's really everywhere. Is what we've seen is that there is a universe of stocks in the S&P 500, a lot of it's energy, but also other value sectors that are moving inversely to the index on a day-to-day basis, almost hedging AI exposure. And the good thing about it, instead of spending money on options premium or holding cash, is these stocks have provided a very competitive rate of return in a challenging market.
And you've labeled them negative beta. And you put some examples. Oh, let's bring up this table. So these will be examples of negative beta, the sort of things that you can own to hedge your portfolio.
Right. Again, consumer staples, telecom. As I said, there's lots of energy in there. There's also insurance stocks of all the strange things, but they have been moving consistently inversely to the S&P 500, and they did. You think about a month like July, when you saw the kind of drawdowns you saw in technology, people are inclined to sell. Well, the answer is you don't sell. That's when you try and hold the fort down, and these stocks help you do that.
Yeah, and before you go, sort of along the same lines, I like that you wrote, you buy options when the VIX is low, the VIX is very low now, and you buy stock or equity when the VIX is high. Can you explain that a little bit more for the audience who may not get that?
So if you look back the last 3 or 4 years, we had a VIX spike and stock sell-off during the war with Iran, going back to the tariff tantrum, and these things happen all the time. And frankly, what it is taking advantage of the fact that people become fearful, right? And that's when you should put money to work. And when people become greedy, which I think we could argue they are to a certain extent right now, that's when you think about hedging.
No, I love all of this together. What I love what you're saying and what you've done is almost like investing judo. Instead of panicking, there are ways to grapple with things, circumstances, and not make mistakes, because ultimately, to your point, people have missed a lot of this rally being reactionary instead of having a game plan. I like this a lot. Thanks a lot.
Thank you.